Hey, everybody, and welcome to this month's Traders Workshop. Great to have you here. We kind of got screwed up on the times this morning, so we had to reset this presentation, and I think we probably lost a lot of you on that. So you can always watch the recording, and we'll get back on track. But just so you know, going forward, it's going to be on the second Friday of every month, and we're going to do it at 1 p.m., all right, Eastern Standard Time. So just jot that down and we'll get those times squared away going forward. All right, so a couple of things also too. This is our third one we've done. So the previous 2 months, the first one, we did it on the art software and how it all works. The second one, we did it on the enhancers and how they work. So if you're interested in those, they're on YouTube, on the channel here in the history area. Just check those out when you get a chance. All right, next month, like I said, it's going to be the second Saturday of the month. So that's February 14th. We're going to be here at 1 p.m. Eastern Time, and we're going to go over trading psychology, talk about revenge trading and ways in which you can handle that. So don't miss that one if you're into trading psychology. All right, so today we're going to talk about using multiple time frames, and I'm going to switch over right now to the PowerPoint. All right, so we can discuss that. And let's go ahead and get going here. There's a few things I have to cover before we do get going into it. So let me go ahead and get started here. Okay, so first thing is that this presentation is actually an introduction to a home study course that we do offer on multiple time frame analysis. So keep that in mind. If you want to take a deeper dive into this topic, we do have a home study course. Very inexpensive. I'll put a link up there. In fact, why don't I do that right now? Well, I'll do it in a minute, but we have it at the end of the presentation. So you can check that out, and I'll put the link in the recording as well. All right, so this is kind of an introduction. We'll be here about 30 minutes or so today and go over this stuff. For those that don't know me, my name is Bennett McDowell. I've been trading for over 30 years. I founded traderscoach.com about 26 years ago. We went public. And we've been basically one of the premier online websites for the last really 26 years. We've done the trade shows. We've done the whole 9 yards. We've been to the New York Traders Expo, pretty much all the ones around the country, and presented basically trading concepts, everything from trading psychology to risk control, to using a strategy and trading software and so forth that we offer. So you can check our website out at www.traderscoach.com. All right, so before we get going, I do have to go over the presentation disclaimer. And the purpose of this is just to make you aware of the risks. You know, past performance doesn't guarantee future performance. I think we all know that. And also realize that we deal in a realm of probability. So you always have to use risk control. Super important. Also, too, any concepts we cover here, you know, I don't know your personal situation, so always run those by your financial advisor or whoever manages your money, just to be sure they're suitable for your situation, okay? That's really important. All right, so a couple key points up here. When we talk about multiple time frame analysis, all right, you have to have an understanding of the underlying structure or the matrix of markets to understand and implement multiple time frame analysis and why it works, basically. So this is a key point. You got to get to a point where, well, why does it work? A lot of people don't understand that higher time frames, even on the same market, all right, are going to have similar patterns of what we see on the lower time frames. And so that's something I want to go over really quickly here. All right, so, you know, in terms of technical analysis is what we're talking about when we're talking about multiple time frames. But it allows the traders to view the matrix of price patterns and market truths. So when you look at a chart, all right, you see the history of price. And that's a truth of the market. You know, there's a lot of manipulation that goes on in the markets as the markets unfold, and that's covered in price action. We'll have a series on that. But when we look at the history of price, that is a truth of the market. So technical traders also believe that everything about a market is represented in price and price patterns, that history as well as the current price. Now, that means that all the smart money as well as other types of money, like retail traders aren't considered always the smartest money, even though we think we are, right? But the thing is that there's a lot of very smart people trading in the markets, and the current price represents everybody's thoughts on where value is at that current time in the market. So that's kind of what separates technical traders from other types of traders. They believe that everything is represented in the price of a market, all information. All right. So basically, does price represent all known information? You bet it does. Okay. Or else it wouldn't be where it is. So smart money, dumb money, whatever you want to call it, is represented in the current price. So it's an absolute truth of the market. All right. History, price history. Is that important and truthful? Yes. Okay. So not only current price, like we said, but past price as well. So therefore, the patterns that price form are an absolute truth of the market and represent the history of price action in market caused by events leading to buying and selling of traders trading that market. So therefore, price and price patterns make up the matrix of the markets and are represented by many different forms of patterns that we see, like support price levels, resistance price levels, fractal price levels, fair value gaps, order blocks, etc. And then you have all the patterns that you can look for as well. So all that is represented in the history of price. And your goal here is to really understand this, to make money not only in bull markets, but in bear markets as well. So by understanding how to use this information that's on the charts, we can therefore formulate a trading strategy. All right. So let's talk a little bit more about price action. Markets are a system that arises from natural human behavior. Price patterns are part of its price history, and since human behavior is repetitive, these patterns also tend to repeat, not only in different markets, but when you're looking at the same market across multiple time frames, you will see similar patterns. And that's because there's traders trading on all the different time frames, but they're trading basically the consequences of human behavior. And basically, when we talk about that, you know, you're talking about fear and greed, okay? So people in markets usually take the path of least resistance, and therefore when they hit an obstacle, they change until they hit another one and then change again. That change of behavior in the markets is caused by the obstacle known as fear and greed. So every time you see a market go up and change, all right, there is a reason for that change, and that reason is going to usually be associated with fear and greed, okay? Even when we talk about the markets being manipulated to a swing high and taking out liquidity, you still have people that think the market's going higher, so they get sucked in only to see the market reverse for whatever reason, and then they get fearful and get out. So those points of turnaround, those fractals in the market, and fractal is nothing more than the definition of a change in behavior. So when you see those fractals in the market, they're going to represent greed areas as well as areas that can represent pain as well. All right, so we see these changes, okay, represented as the price patterns we can use for a trading system design or a strategy. So you can use that information to your benefit. All right, and when we talk about market symmetry now, what is it? How can it help us? Let's explore some charts. I'm going to show you in just a minute that will illustrate what that is and how it can help us and we can interpret this information. All right, first thing I want you to do, all right, and you don't have to answer in the chat, but just think about this. All right, I want to ask you what market this is, what time frame this is, and obviously you're not going to be able to tell me, right? And why is that? Because no specific market or time frame, all right, has a monopoly on what price structure is going to look like. So you can see these patterns on just about any time frame you want. This happens to be a daily chart representing a stock called SSI. Let me just show you a couple more, okay? How about this one? All right. It's impossible to tell, right? Well, this one is the S&P E-mini on a 2-minute chart. How about this one? All right. This is light crude oil on a daily chart. So I think you're kind of getting the idea here that you see these patterns, but it's impossible to tell what market they are because they occur on all markets and all time frames. All right. And that one is Applied Materials, which is a weekly chart on that particular stock. All right. So we can't tell what market and time frame these charts represent because market symmetry duplicates itself on all time frames in all markets. So basically, they're repeating patterns that we see. Now, why is that important? All right, because what we can do is look for similarities on different time frames of the same market we're trading to see if they are basically confirming what we think is going to happen in that market. All right, so that's how they can help us. All right, and we focus on price when designing a trading system or a approach because we want to be able to use market symmetry on that trading system across multiple time frames. You know, if you have a trading system that only works on, one specific market or one time frame, then they're not using market symmetry. They're not using pattern analysis or even any type of price action at that point. All right, because it's the same on all markets. So if you could basically design it for one, it should be able to be used on all. All right, so this allows us to analyze the same market using the same trading system on multiple time frames to help us determine the short-term, intermediate term, and long-term trend of that same market. And maybe it's not a trend. Maybe it's a consolidation. So basically, that's what you want to look at to see what's going on the different time frames to see if they're in alignment, okay? And if you guys have any questions, feel free to ask in that commentary. All right, here's a key. The matrix of the market symmetry is the reason we can apply multiple time frame analysis to any market in any time frame using our technical analysis. So basically, I also want to talk about market fractals. We discussed them briefly before when we talked about fear and greed. But what is it? Is there more than one? Can we see them and identify them on charts? Do they occur on all time frames in all markets? And of course, how can they help us? So the first thing you need to know, and we again briefly touched on this, but a market fractal is a change in behavior. All right. And when we see it on charts, it represents changes in mass trading behavior. And it's usually followed by fear and greed, okay? You can see these represented as repeated price patterns on all markets and time frames. Is there more than one market fractal? Yes, you can see them in many areas, pullbacks, extensions, and so forth. So anytime you see a change in behavior, it's a fractal, all right? Now, on this chart here, you can see all these changes. Now, fractals, when we look at a market like this, to me, can represent opportunities. There are also points of specific fear and greed in the market. So, for example, if you're taking a long trade here, all right, it moves up and you see it pulling back, all right, that's going to create, for some people, a fear, okay? And some people may exit the market. those that have a specific trading strategy, and this is why strategies are so important, that you will be not fearful because that strategy will replace the emotion of fear and greed, so you stay with your trading plan. You know, when you talk about fear and greed in the markets, you have to go back to the fact that human beings are basically, in any living thing, is always quick to assess a situation as fear and greed. And it's worked for us most of the time, especially when in prehistoric days or something, when we were hunting and basically we saw a adversary, we've run, right? In the markets, we have that same feeling when we start to see something going against us as a loss, because a loss is not what we want to see. So you have to be very careful not to, so to speak, react too quickly. And this is where a trading strategy can come into effect. But the point is, all these points represent fear and greed depending on the trader's orientation of his trade. And the fact that you see a turn in behavior or market structure is a fractal for the most part, because a fractal is a change in behavior. So when you think of a chart here, basically you see these same fractal patterns on all time frames. And that's why it's so hard to look at a chart without a X and Y axis representing time and price to know what you're really looking at in terms of time frame, and likewise for the type of actual market you're trading. All right. Now, when we talk about multiple time frames, basically, I want to jump to the practicality of what we're doing here. So that's, we talked about the theory and all that kind of fun stuff, but, what does it look like on a chart? Well, you can use this, first of all, for swing trading or day trading. It doesn't matter. But this example here happens to be more of a longer term, what we call position trade. So on the right-hand side, okay, we have the weekly chart, and this just happens to be the ETF for USO for this example. The center chart's the daily, and the left-hand chart is the 60-minute chart, okay? Now, just so you know, as a reference, for some charting platforms, if you're using free data, you'll be able to set this up with a daily and a weekly, but you may have to buy intraday data if you want the 60-minute chart, okay? Likewise, if this was a day trading situation, your time frames would be different. This may be a 5-minute, okay? This may be a 15, and this may be a 1, okay? So that type of thing. So it all depends on the style of trading that you're doing and how you want to set this up. And basically, you can certainly see on this example, I'm just going to erase that for a minute. You can certainly see on the longer time frame, the weekly, all right, we have a move up, all right, and we have the beginning of a bearish price bar, okay? Notice on the daily, all right, we can see that retraction inside the bearish price bar on the weekly. And then notice on the 60-minute, we see even more of a contraction, all right? And then we see possibly the beginning of a retracement off that. So when you take a look at this particular market here, okay, and you analyze it based on your strategy, what you should do is take a look at your strategy on each time frame and see if they're in alignment. Because if this is saying, let's just say in this example that, okay, I got to be careful, this looks like it may sell off again. We'll see here. Certainly we reached the top and pulled back. We don't have an entry in here yet. We may have an entry in here for a short-term trade. So that information is important to know. So if you go long here, all right, it may not be done correcting. And so therefore this would be more of a scalp trade or a pass, because none of them are definitive yet in the type of strategy you're using. And there's, tons of different ways in which you could trade a market like this. But the point is, whatever your strategy is, you want to make sure it makes sense based on the different time frames. Okay. So in this case here, if you were to go long, you'd have to be a little weary that, you still could be in a correction. So your duration of the trade and your stop loss, you may want to move up quicker than if it was just a strong trend up without a pullback on the weekly chart, that type of thing. So multiple time frame analysis can really be used to hone in when to use your strategy. All right. Any questions on that? Feel free to ask. Okay. All right. Here's one using our software. So USO again. All right. Same chart, just different situations. And now the software that we use, and this is called the ART software with the OWL, PTF, and TLM. Many of you that watch our stuff and know about our workshops have this software already. But notice a couple things. We have a green PTF on all time frames. All right. We have 3 pyramids to the upside. So it's a fairly mature trend. All right. On the daily chart, we even have more. All right. We're obviously in a pullback. All right. And you can see the pullback magnified here. All right. So what does all this mean? Well, the way I would read this based on the multiple time frame is that more highs are coming based on this indicator, right? That this pullback we're in is a temporary correction, also known as profit taking. And the next question is how far down it's going to go. Well, you could draw fibs and you could draw it from here to here on your short term, and it would probably end right about there. Okay, so it looks to me like it's reached its fib retracement. The other thing you can take a look at it is look how powerful the OWL histogram is that measures momentum. Okay, on these 2 time frames, extremely high. So that supports another high, right? While this one is red, indicating it's a correction. And when it goes green, then it should start to pop up for a potential trade. Then we wait for what? Our pyramid trading point on the next leg up. In terms of an Elliott wave count, this would be a 3 over here, a 4, and a 5. We're still in 3. And in this case here, probably because this is so large, this is 4 is going to be the minor 4 inside the major 3. There are 5 waves in 3. So this wave 3 is not done yet, but will be done when we reach another high into wave 5. So this is wave 3 still unfolding. So do you see how multiple time frames help you in that? Because if you were looking at just one time frame only, you would miss the big picture. And so this is just a great example of that. And notice here, okay, that by looking at the lower time frame here, we can kind of put this little correction under a microscope and see what the Elliott wave account is on this time frame to help us feel confident that the 5th wave will take out this high normally. And this indicator supports it that we use. So in that case here, we'd be looking for a long trade, not a short trade. All right, but we want a little more confirmation to be sure the correction's over. And that confirmation would come from a green owl on the 60-minute time frame. Anyway, that's basically, and again, you may not there at home be using our software, which is fine. But whatever strategy you're using, by using these 3 different time frames, you increase your odds of a better result. And also you get the bigger picture of what's going on. Okay. If you looked at the weekly chart here, all right, you may look at this as a bearish price bar and not really see what's going on inside that bearish price bar. And that's what the lower time frames do on all time frames. Okay. So here's one just before we end here. I just want to show you this one. This is the E-mini. Okay. Actually the micro E-mini, micro ES. And notice here, it's on, let me just label this so you can see it better. We've got a 5-minute, a 1-minute, and even a 15-second chart. Okay, so that's a really short time frame on the left-hand side. And this was obviously years ago, but doesn't matter if it's now or years ago, it's the same situation. So we've got a green PTF, we got a 3, 4, 5, and we're probably still in a 3 here, just like the longer time frame. And now we're moving up into the next impulsive leg on the 15-minute time frame. So it doesn't matter what market, because of fractal symmetry, doesn't matter what market you're looking at, but what you want to try to do is get a big picture on the overall situation. So I wanted to put a couple links in here for you guys, because I'm going to put that in the comments area. I want you to also, I just want to mention here is that, give me 1 second. Let me just post this here. It will show up probably in a minute or so. So I put a link up to our Discord channel, and we're going to start in 2026 posting more events in Discord versus email. All right, a lot of email is becoming almost a situation where it's people prefer to have it on social media. So we're going to put it there. We're going to put it on our Facebook page, and we'll let you know. You can always go to our YouTube channel and see upcoming webinars as well there, because we'll post some of them there. But go to the Discord. Go ahead. It's a free place you can go. It's kind of like a blog. But all our upcoming events will be on there. You can go to our website as well at traderscoach.com. But we really kind of want to start boosting our Discord channel in 2026. So you go there instead of relying on emails to know when events are happening. Okay. So make that kind of on your checklist for this coming year. All right. The other thing, and you can do that, you can go there now and do it or whatever, but you may want to copy that link. And then the other thing I wanted to mention too is our multiple time frame online home study course. All our online home study courses, okay, once you purchase them, all right, you have access to them forever, okay? So they're always available to you. So there's no, time quota or anything like that. But I'm going to put a link up for that as well here, okay? And that's the multiple time frame home study course. And it's not much money. We made it really cheap so everybody can participate in it. But it's going to go into more information than this, and you'll learn about how to figure out what time frames to put on different markets. For example, what is your goal, and from that goal you can determine what time frames to choose for your multiple time frame setup, and things of that nature. Okay, so you may want to check that out. I'll leave that link up, and we'll put that in recording for everybody that was able to attend today. So I know we kind of, had some, we had to reschedule this a couple times because of the time problem we had. Some of our emails went out at the wrong time and so forth. And then that kind of screwed everybody up. But basically going forward, all right, this is the way it's going to be. Second Saturday of every month, and we're going to do it at 1 p.m. Eastern time. All right, so that will be the way it goes forward. All right, so that's it for today, okay? I want to thank everybody for attending. If you're watching the recording, enjoy that. And we'll be back next month on February 14th at 1 p.m. And we're going to talk about trading psychology on that workshop. So have a good one, everybody, and thanks so much for tuning in.